Coming up on the SBS On the Money Markets podcast, the ASX suffers another outage. Is a Santa rally coming? We take a look at the future of property prices. All that and more next. Hello, everyone. Welcome to the SBS On the Money Markets podcast for this Monday, the 1st of December, 2025. Later, we'll take a closer look at the property market with Eliza Owen from Cotality. But we're starting with the markets today because what we saw was the latest in a string of technical issues at the ASX, which is also under scrutiny from regulators over its governance. Early this morning, it had problems affecting the publication of company reports, adding that shares of those companies with a price-sensitive announcement would remain halted until the issue was resolved. That impacted around 80 of those companies. And it came on a day where the ASX 200 fell, down by 0.57% to 8,565. 8 of 11 sectors were lower. Healthcare, the worst performing. That sector down by about 1.9%. Consumer staples, information technology and telco also weaker. The three doing well, energy, materials and utilities. And of the best and worst performing stocks, AUB Group, the worst performing, down by 17% on a failed takeover. Metcash also down. It was one of the stocks impacted by this ASX outage, but the market didn't like one of its profit updates. Shares down by 9%. To take us through the day's market action, I spoke with Chris Weston, the head of research at Pepperstone. Chris, first of all, trading was disrupted today at the very beginning of the session by a 3-hour outage at the ASX. It blocked the release of market-sensitive information. Can you run us through just how disruptive was it? Did it impact you? Did it impact others? Because it certainly isn't a good look for an organisation, I guess, trying to win back trust following previous tech and governance issues.
Yeah, I mean, I think these things, people do go back and look at past situations, but I will say this is no way near as disruptive to markets broadly, obviously, as what we saw on Friday with the CME going down because of cooling issues at the data centers. I mean, that was genuinely a big deal. It's the biggest exchange out there, so in terms of commodities anyway. And I think you got to put it in perspective that this is nowhere near as bad. But locally, I mean, I don't think we saw a huge amount of disruptions personally. Speaking is, I think most of our clients are certainly traders. They're not necessarily driven by company releases or news. The price is probably the most clearest fundamental that they need. But I think, obviously people do need real-time information. They need that information going to them as quickly as possible, as efficiently as possible, and on a very level playing field. And obviously, people have taken out this idea about what happened with Metcash, where they had to go into a trading halt. They opened up this afternoon and they're down, at the moment, down about 11%. But it's really about the efficient dissemination of information that allows us to price risk, allows us to price the reality of what's going on in terms of news to valuations and the price. And that needs to be seamless. So, of course, people will be looking at this very closely. And it was, for the 80 companies, I think, that wanted to come out with information at the beginning of the day, of course, it was, and I guess it's not just about for investors, it's about the companies wanting to actually release this to the market themselves. So, this is just, it's not a great look. I don't think it's just anyway as disruptive as what we saw from the CME. But, we want that information to be able to price risk and certainty. And, if that's held from us, it makes our job a lot harder.
Okay, that aside, what's investor sentiment like at the moment as we head to two key interest rate decisions, one by the US Fed Reserve, the other by Australia's Reserve Bank?
Well, I think the GDP number here in Australia is going to set the tone. We've got that coming out on Wednesday, and we're looking for that sort of go up 2.2% year on year. And that's a good number. I mean, the problem is it's going into what we call above potential. That potential, if we call it that, is that equilibrium growth rate where it goes above 2% into the above potential. And what that does is it boosts price pressure, or has the potential to lift price pressures at a time when they're already a bit concerning. And I think what's interesting here is while we're not going to get the RBA are not going to do anything in the December meeting, we are starting now to see in terms of market pricing the belief that the RBA may have to hike rates next year. I think we've got about 10 basis points or so of hikes being priced out by the next 12 months. But that sort of information that could build as if we get a really hot GDP number, and we could start talking about when we start talking about interest rate hikes in Australia, as we are with New Zealand as well, where the new governor's coming in and the market's expecting the next move to be firmly higher. I'd also add that we've got the Bank of Japan meeting this month, and after we just heard from Governor Ueda today, the head of the Bank of Japan, it looks more likely than not that we're going to get a rate hike from the Bank of Japan, a 25 basis point one on the 19th of December. So that's an interesting mix to be had. And the Fed meeting, which comes out on the 10th of December, the market's hell bent on believing that we're going to get a 25 basis point rate cut, but it doesn't necessarily mean we're going to get a rally if we do that. A lot of it's being baked into the cake already. We could actually see a situation where the Federal Reserve cut rate to that situation, but it's then coined as a hawkish rate cut, in the sense that they're suggesting that they may go and hold after a while, in which case, you may see equities under pressure. But I'd say sentiment, certainly going into this week has been much more positive. And that's the case in European equity markets and US equity markets. Our market's been a big underperformer for 2025. But I'd say, we're seeing a bit of a disappointing tape today. It's a bit of a soggy start to the week. But, going into today, certainly risk was looking very, very positive indeed. And it looked like this old Santa Claus rally was back on. So we'll have to see if that changes around. There's a lot of risk coming through in December. But at the moment, going into this week, it's certainly looking much more positive.
And speaking of rally, I think all this interest rate talk has been supporting the Australian dollar, especially against the US anyway. Even crypto has been hit today, though. What's your take on the currency moves?
Well, yeah, last week we saw the Aussie and the Kiwi as the standout currencies, but I think it was a broad US dollar sell-off last week. The US dollar was down against all G10 currencies and all major currencies about. So, it was a question of selling US dollars last week and what do you want to buy? So last week it was, let's go and buy the Australian dollar because things are looking better in terms of less rate cuts, more rate hikes, and obviously after the RBNZ meeting last week, it does seem that their cutting cycle's now over, and it's a question of when they'll look to hike in 2026. I think the Bitcoin situation's a somewhat different scenario playing through. I think what we've seen today is we saw a move up through last week into 93,000. And it's just given all that today. And I think, what we have seen is a soggy start to the week. I think you could probably largely put this down to Japan. The Nikkei's down, down pretty heavily at the moment, down about 1.8%. And when we saw that market, when we saw Nikkei futures open, S&P futures started coming off. And that's when we saw Bitcoin really selling off. And as it broke through sort of 89,000, we did see a lot of the leverage positions coming through in the derivatives exchanges in Bybit and whatever, causing some of those leverage positions to close out. They were squeezed out. They had to sell to close. And, that's taken us down pretty hard on the day. So it's not a great look for Bitcoin today, but I think it has been pretty well correlated to the moves we've seen in the Nikkei futures and S&P futures. It just runs at a much higher, what we call higher beta, higher percentage change relative to those markets.
Okay, and finally, what are you telling your clients right now? Where do you see the opportunities for investors?
Well, I think we've seen, precious metals continue to be very, very well supported at the moment. And, that's been the place all year to go through. But silver's the one to look at the moment. Obviously, it's ripping. It has absolutely blown up. And we continue to like that in the short term. I think pullbacks will be fairly shallow and well supported. And after people were seeing a bit of disappointment from gold to silver, it's now come back to life again. And we'll see if that can continue to kick going forward. I think on the equity side, I think, are we going to get this seasonal rally, the Santa Claus rally? We're just going to be open-minded on what can happen. I believe there's a high chance it will happen, but a lot needs to go right. We've got a lot of landmines, event risk landmines to go through in December. The Fed meeting, we've got a Supreme Court decision on the Trump's use of tariffs, which could get very messy. Bank of Japan meeting, all these factors playing through. We're going to get a new Fed governor who's going to be announced probably before Christmas, and that could have big implications for markets as well. So I think you just got to be open-minded to what the possibilities are. At the moment, it looks like I feel like we're going to see equities higher into year end, and I think I want to go along with that situation. But we could easily see a situation where some of this event risk permutates, impacts volatility, and people say, do you know what? I've had a good year. Let's cut off shop. And let's hope the index falls by more than that amount, so I outperform in that situation. So a lot of risk this month. Just stay very open-minded to the possibilities. But at this point, we're staying very, very pro risk into year end.
That is Chris Weston there, Head of Research at Pepperstone. Let's now take a look at the property market, where property price growth is expected to slow despite another 1% increase in national home values in November, the median climbing to nearly $889,000, according to property researchers at Cotality. And of the capitals, Perth was the standout, up 2.4% last month, followed by Adelaide, Brisbane and Darwin, each of those capitals up by 1.9%, and Perth was the standout as well. As I mentioned, Darwin rather up 17%, the best growth over the past year as buyers seek more affordable housing. But with credit growth expected to slow, given the prospect of no further interest rate cuts, along with new high-risk borrower lending limits imposed by the banking regulator APRA, price gains are likely to ease somewhat. By how much? For that and more, I spoke with Eliza Owen, Head of Research at Cotality. Eliza, I guess first of all, how would you describe the property market at the moment?
The property market is expensive. I think it was somewhat revitalized by interest rate reductions in 2025. That's taken home values 7.5% higher over the past 12 months. But now that we're back at this stage where interest rates may be on hold for some time, the cracks are starting to show a little bit. You've got a slowdown in monthly growth across the Sydney market, which rose just 0.5% compared to a recent high of 0.9%. And I think that with the additional kind of risk that's emerging in the market, such as increased investor participation and a fall in first home buyer participation, that might add some layers of complexity from institutional intervention as well.
Yeah, that's all kind of interesting. You mentioned that change in expectations of interest rates. For quite some time, we were thinking there was going to be another fall. Now it would appear the market's pricing in no change, a potential for an even increase toward the end of next year. Add that to APRA's new limits on lending on those higher risk lenders. What's the outlook for prices then?
So that makes the outlook softer. I think that we've got cost of living pressures, affordability pressures, and against a backdrop of rates expected to be steady for some time, and definitely a signal that APRA can intervene if they see lending becoming potentially risky. This is likely to limit credit growth and housing demand. The flip side, though, is that it is happening against limited supply. Both sellers are empowered to hold their property back if selling conditions aren't good, and developers don't establish new housing stock if the price signals aren't there either. So that's one thing that offsets that lack of demand and is why we would expect at least some continuation of price increases into 2026.
And going back to the market, 3 months of gains of more than 1%, what's driving it? What kind of properties and where exactly?
So the market has very much been driven by the low value segment. Property values that are in the bottom 25% of Australia's dwelling market have increased almost 9% through the year to date, compared to a 6% increase at the high end of the market. We also see areas like Brisbane, Perth and Adelaide continuing to lead gains. Perth was up a whopping 2.4% over the past month. And we also saw a really strong increase in Darwin over the year, up 17%. And it's the same story. It's a relatively cheap market with room to grow. But again, I think that's a signal that you have real affordability constraints in this market when even medium and high income buyers are being skewed to the lower value segment of the dwelling market.
That's Eliza Owen there from Cotality, and she wraps up the podcast for this Monday. Don't forget, give it a like and a review on Spotify and Apple Podcasts. Click that subscribe button, and I'll see you tomorrow.
This SBS on the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.